All right. Well, good afternoon, everyone. I'm here with my really good friend, Brian Loo, calling us from Los Angeles. Brian, thanks for joining us. It's good to see you today.
Likewise, Jonathan. Always good to see you.
Yeah. Well, let's jump right in. $6 trillion of assets is sitting in money market funds and on the sidelines, so to speak. And especially that seems to have a huge impact on the bond market. What's going on? How has that impacted you guys as investors and your worldview, specifically investing in real estate and mortgage-backed securities?
Sure. Thanks. I think that the most interesting thing about the last 2 years is that people kind of felt, well, if I can get so much yield at the front end, why am I bothering with the broader market? I think Chair Powell made it pretty clear earlier this year, for example, that they weren't done, that they were going to win this fight versus inflation. And so people thought, why don't I just kind of camp out and hide at the front end where I get pretty good yield anyway, and let the Fed work through all of its wondering and its machinations and its calculations and all that stuff. So that's been what's going on for most of this time. But certainly, I think with the last meeting and the comments afterwards, and sort of the market waves too, that a lot of that is really coming to an end. As always, I think the Fed left it open for further hikes, but I think that most participants now kind of believe that they're pretty much done, and that should open the door back again for people to resume getting back in the water, so to speak, and dipping a toe in fixed income.
Well, the thing that, like, I'll give you an example my dad and I talk about is this has been a weird dislocation that things with good fundamentals or good collateral or good book value aren't holding up either. And to me, that just doesn't make sense. Maybe over a short term it does, but this has been like 2 years where we've seen fundamentals don't matter. Like, why is that happening? What's really at play in that context?
Sure. I think the most interesting thing is exactly about that statement is that these fundamentals, for example, in non-agency mortgage-backed securities, which we invest in, the underlying homes have been solid. The borrower has been solid. They survived the GFC, and here they are many years later. They're still in that home. They've got a great LTV. They've been making payments, and housing has not cratered, or there has not been a second GFC as a lot of people thought there might be. So housing has held up really well, and those are the folks that are underpinning these securities. There's no reason that they should now be looked at as securities that are going to have any sort of distress, or that are going to get less than par back, or any of those kind of considerations. And yet they're trading worse than things like unsecured corporate obligations, high yield bonds, and otherwise. I saw an interesting article in Bloomberg which talked about high yield and credit obligations trading with things like the VIX. And with the VIX being low, a lot of those things have been propped up and those credits have stayed solid. Whereas, by contrast, you could think of MBS, where you're short that call option. I got to make sure I get my bond math right here, but short that call option on agency securities. And because of the inverted yield curve, that, or the volatility in the MOVE index, I should say, that option has been more expensive. And so you're getting kind of a double whammy on your ownership of those MBS, right? So agency MBS have gotten to their wides, several year wides, whereas corporates and stuff have held in. And so it just seems kind of counter to what you believe in terms of what I mentioned about housing fundamentals and such versus something like an unsecured corporate obligation. But I think a lot of that is, again, I think that when folks come back to fixed income, when a lot of that money, the money that's been on the sidelines, so to speak, comes back, a lot of that should normalize, right? Or it'll kind of rationalize, maybe is another word. And people will kind of get back to this regular trading of fixed income. And the money that's going into those sectors that is typically gone into those sectors from larger money managers as well as specialized or niche money managers, I think a lot of that will help straighten out a lot of the dislocation that seems to have existed for the last couple of years now.
Yeah. Well, you said something interesting. You talked about bond math. So I'm curious how money on the sidelines in, say, a money market fund, where, full disclosure, I have money in a money market fund and not my savings account anymore either. What's the bond math look like if money comes off the sidelines into the market? Where is it going to go? Like, how will that decision be made? You talked about spreads. You said a lot of stuff. How will that money find a home in the bond market?
I think a lot of it will make its way through something just like a regular large money market, a large money manager core bond fund, right? They'll go into something that's ag based. That'll be something like 35% treasuries, 35% mortgages, 20% corporate credit or 25% corporate credit, and the rest kind of filling in cash and such. Those flows have been absent for a while. And so with money that has come out of those different sectors, that has kind of caused a drag in some of those spaces. And then I think if you talk about some of the things about being short the call option and that sort of thing in agency MBS, plus a lot of the issues that banks have had with their non-AFS holdings just weighing down their balance sheets, or the prospect that they'll have to be selling a lot of those securities, that has really weighed on the structured product sector more than on corporates. Even treasuries, you could think of just on a generic sense, long treasuries or even 10-year treasuries to an extent, they're trading in the 40s and 50s, right? Or the 10-year maybe in the 70s because they simply had a low coupon. But it doesn't mean that they're not going to get par back, right? It just means that at this point in time, they're looked to press on a much lower price basis because of their low coupon, right? And so as a lot of that money comes back into an ag-based fund, for example, you'll see a lot of it kind of propping up or getting back to the spaces that it used to be involved in or used to be invested in. And that should, again, kind of normalize some of those things.
Gotcha. Well, so one thing that's interesting about those diversified core bond funds that I've heard you guys speak about a lot, that I'd love to get your kind of some clarifying statements about, is there's this idea in these bond structures that you can write back losses, right? So I think of par for a bond and some discount to par, and if something loses its value, the money disappears. But for you guys in this weird sector of non-agency residential mortgage-backed securities, there's this idea of right loss or loss write-backs benefiting the bondholders and hence benefiting investors. Can you go through that math at a high level so we can understand what that means?
Sure, and I think it's also really interesting to talk about this sector because a lot of the issues that agency MBS have been having, and so when I mentioned that, for example, ag-based money managers are going to allocate to quote mortgages, it's not going to be all agency mortgages, right? There's usually a bulk of it there, and then some of it will be in non-agency, and some in these other specialized sectors, which we're about to discuss now. There are certain bonds within that space too that, again, as it's called a legacy bond because it's got borrowers who've been in there for such a long time, 15 to 20 years. These securities were created in the early aughts before the GFC. So now you've got a great borrower with great credit. You've got them paying an typically off-market rate. Well, I should say off-market for the last 10 years, but now that mortgage rates are higher, it's not so much or as much off-market. But because of that off-market rate, they were producing excess spread, right? The amount that they were paying into the trust was higher than the amount being paid out in the coupon because the coupon is floating rate. Now, again, given that that's kind of reversed, there's certainly much less excess spread, okay? But excess spread means that there's more interest available or being produced in the by the collateralization pool than is due to the bondholders. And so you have this excess amount of money that's left over. And to the extent that some of these mezzanine securities, right, which are the lower tranche or the lower credit tranches in these bond structures, to the extent that they took losses, usually during the GFC or even in sometimes afterwards, but to the extent that they took losses, they are then entitled to write back a lot of those losses when there's a means available like excess spread. Right. So when there's excess spread, it means there's extra money available. This bond took some losses prior, so it should go towards repairing or building back some of the losses that bond had taken prior. Now, if we bought the bond at a time after most of those losses have been taken, then any losses that we get written back, which again had if I said that right, the bond had experienced a loss before we bought it, right? So we bought it after it had already taken the loss. The loss gets written back, that means that we're going to get money back on top of what we thought we would buy, right? So we bought a 7 million face bond, which had originally been 10 million. And so we thought that we were buying 7 million face. Par means we get back 7 million. Instead, we're going to get 8 million back, right? So that means an extra million on that 7 million. So it's kind of like getting 114 back instead of just par on that bond.
Yeah. Well, that's pretty exciting, right? That it's like found money. Is there any cap to the amount of money that can go towards that right loss or recovery?
Yeah, it's going to be capped by the amount of the original issuance size of the bond, right? So in this case, where it was 7 million, you're only entitled to get an extra 3 million back. I think another thing is that it's not as if there's, the way that money comes through, just to be clear, is through these underlying borrowers' regular payments of principal and interest. Okay, so there's money that's being generated, or there's over collateralization that's being generated by this excess spread, and that over collateralization comes back, or it's still due in effect to these bondholders with prior losses, and it'll be paid out over time or through the waterfall of the bond, right? So it's not like a magic bullet or something like that, but it's just that you will recover more of that money as you go along owning that bond.
Yeah, well, that's a great inefficiency that a good investor could take advantage of. Well, Brian, let's close here. So a lot of money's on the sidelines. Fed Chairman Powell has made some good intimations that maybe rate hikes are over. Is 2024 going to be a good year? Do you anticipate that money moving back in the market? Is there a sense of risk on that you're seeing?
Yeah, I think ever since the last meeting, the bond market started to believe, and people started to say, okay, I do think we can go back. We're clear to go back in the water, start testing the water again. If you think back about a year ago, 2022 had been a horrible year. People wanted to put it in the rearview mirror and get on to 2023. January 2023 started out as a great month. People thought, again, we got that behind us. We're going to move ahead now. And then more data about CPI being higher, a pretty strong jobs report. And before you know it, the Fed is out there beating the drums again about how they're not done, and bond yield, rates have to go higher. And that pretty much just chased everyone out of the water again. And they kind of waited on the sidelines, kept rolling T-bills. And I think now that we've gotten more clearly to the end of that, 24 should be more like the year that we were expecting when we saw January 23.
Well, let's hope for that. That would be great. Let's get some money back off the sidelines, so to speak, and make these bond markets a little more normal. Well, Brian, thanks so much for joining us. It's great to see you. We'll probably do more of these in the future because you're really good at it. And we appreciate your insights and looking forward to a good closeout of the year here. Have an awesome rest of your day.
You too. Thanks a lot, John.
Take care, bud. See ya.
Bye.